Welcome back to Module 2, Part 2. And in this part, we're going to be talking about the actual journal entries. In the last part, we talked about the normal balances, and that really builds up to where we need to be for this part. So, debits and credits, we defined those, and we talked about journal entries. We talked about the entire accounting process. Now we're starting to get the detail of that journal entry development, the recording of the journal entry. So in the next slide, we're going to see a journal entry, but what I want to do first is talk about some rules. Debits are always, no matter what account it is, debits are always going to be found on the left-hand side of a journal entry or even on the ledger, the T account. Debits always come first. Now, the other thing I want to point out is debits, that doesn't necessarily mean debt or debtor. I know the word is very similar. They share a Latin root, but debit is just the term for what we're doing to the account. The abbreviation for debit is DR, debit record. Credits are always on the right-hand side, and they always go after all the debits have occurred for that journal entry. Again, don't confuse credits with like a creditor, someone you owe money to. That's not always the case. The abbreviation for credit is credit record, CR. Here is a very basic journal entry, about the most basic you're going to get. Now it shows the date, and you need to know when this occurred. The whole idea of a journal entry is that it's a chronological record of that transaction. So you need to know the date. And in this case, we had one debit and one credit. Our debit always goes first. It's on the left-hand side. It's debiting cash. The revenue always gets, or the credit always gets indented to the right. Now notice we don't even see DR or CR or debit or credit here, but I still knew this was a debit and the revenue was a credit just by the order and the indentation. So we're debiting cash for 100, crediting revenue for 100, and generally you'd have some sort of explanation for what happened in that transaction. Doesn't really matter though. Once you get used to this, you can go through this and just take a look at a journal entry and figure out what's going on. Here, we apparently earned some revenue, sold something, and immediately collected cash. That's the only way this could happen. Here's another example of a journal entry. Now we have a little bit different. We have two debits and one credit. Again, it doesn't matter how many, quantity-wise, how many debit lines versus credit lines we have, as long as the dollar amounts balance. 100 plus 150, that gives us 250 debits, 250 credits. We're good. The dollar amounts are in balance. That's what matters. That's recording a journal entry. Posting the journal entry just means taking each individual line, each piece, and putting it to its respective account. The debit to cash out of this journal entry gets put on the debit side of the cash account in the general ledger or this T account. The credit to revenue from this journal entry gets moved over to the credit side of this revenue account. And then we keep an updated balance. Here we have another entry. We were debiting inventory, crediting cash, and they tell us that's because we purchased $200 worth of inventory with cash apparently. The debit to inventory of $200 goes over to this debit side of the inventory account. The credit to cash gets moved over to the credit side of cash. Now remember, we had a debit before. Now we're adding in a credit. So you're going to end up with a $300 total balance at that point. In the end, we talked about the normal balances. And here are the two different T accounts. This is just a repeat of what we talked about earlier. How we balance an account in general. And we know the normal balance rules. You need to understand those from the earlier part. Now, here are the rules for debits and credits. So we said that every individual journal entry has to have the same total debits as they do total credits. That has to work. Because of that, when you pull those pieces apart, you're going to move those over to a cash account or a revenue account or an inventory account, whatever. Within one individual account, a T account or a general ledger, the debits and credits there do not have to balance. In fact, if they do balance within one account, that means you have a zero balance for that account. Debits and credits are the same, so when you subtract the two, you get zero. However, when you bring all of the accounts back together in the trial balance, they must again balance. So now we're on to our next step of the accounting process, where we have the trial balance. Some of these accounts have debit balances, others have credit balances, but in total, they must balance out. The total debits must equal the total credits. Here's just a listing of different types of accounts you could have. Now, we're going to start talking about the next section, the adjusting entries, both creating the journal entry, recording it, and posting it. So let's first talk about the difference between the cash basis of accounting and the accrual basis of accounting so you can understand why does it matter. Under the cash basis of accounting, revenues are going to be recorded just when cash is received, and expenses will be recorded when cash is paid. So let's take the example of a 2-year magazine subscription that was sold to subscribers in January of 2020 for a total of $24,000, which is $1,000 per month. All $24,000 under the cash basis of accounting is going to be recorded as revenue, even though some of this money will arguably be earned in 2021 when they send out the rest of the magazines. Under the cash basis of accounting, the only thing that matters is when was the cash received. Now let's look at similar situation. Services in the amount of $50,000 were provided to the customer in December of 2020. So that's when they provided the service, but they aren't going to receive the payment until January 2021. All $50,000 of this revenue will be recorded in 2021 when it's collected, even though arguably they earned it in 2020 because that's when they provided the services. Under the cash basis of accounting, again, the only thing that matters is when did the cash get collected. Now let's take a look at expenses. In here, let's say we purchased a 1-year insurance policy in July of 2020. It was $200 a month, so a total of $2,400. Under the cash basis of accounting, all $2,400 of that will be recorded as an expense in 2020, even though part of that insurance is going to be used up in 20 and part will be used up in 2021. Under the cash basis of accounting, it's just the cash transaction that determines when the expense is recorded. Now let's switch gears and talk about the accrual basis of accounting. In this, revenues are going to be recorded when they're earned, regardless of when the cash changes hands, and expenses will be recorded when they are incurred, which basically means that it's when did we use up that underlying benefit. So let's take that 2-year magazine subscription we sold to subscribers in January of 2020. It was $1,000 per month. And again, this is multiple subscribers. But in this case, the $1,000 per month revenue is going to be recorded each month as it is earned. So it's not all at once. It's over time. Let's take a look at the next one, where we have the services of $50,000 that were provided in December of 2020, but they didn't get collected until January 21. All $50,000 of that is going to be recorded as revenue in 2020 when it was earned, regardless of the fact that the cash didn't get collected until later. The expenses, if we take a look at those, the expenses are going to be recorded when they are incurred. So that 1-year insurance policy, that $200 per month will be recorded as an expense every single month as it is used up, regardless of when we paid for it. Even though we talked about the cash basis is not actually allowed under GAAP. The reason is it's subject to manipulation, and it also just doesn't really reflect the true operations of the company. We're more concerned about when we did what we needed to do to earn something and when we used up a benefit that we need to call an expense. We're revisiting the accounting cycle just to show you where we are. So we had all of our initial entries, the unadjusted trial balance. We are now journalizing the adjusting entries, and then of course we'll post them to the ledger, create an adjusted trial balance, all of that. So let's talk about these adjusting entries. They are always going to be done at the end of an accounting period, which means the end of the month or quarter or year. Whenever we're trying to prepare financial statements, they have to be done before the financial statements. The goal is that we want to have the proper balances for all of our income statement accounts, all of the balance sheet accounts, all the revenues, expenses, assets, and liabilities. We also want to correct for timing differences between when something was recorded under the cash basis versus when it should be recorded under the accrual basis. Now, the adjusting entries themselves. We have two main branches of these, and then each branch has two examples or two types of those adjusting entries. So essentially we have four different groups of adjusting entries that we could talk about. The first main branch would be the accruals. This is where the revenue or expense needs to be recognized before the cash has been received or paid. The recognition of revenue or expense come first, and that's the adjusting entry. The cash transaction, which is a regular old transaction, that comes in some later period. The initial entry is going to be the adjusting entry. The subsequent entry that happens later on will be when we received or paid the cash. Now, the other main branch would be the reclassifications or deferrals, sometimes called prepaids as well. This is when essentially cash transaction comes first, but then we need to record revenues and expenses later when something actually happens. So the initial entry is just a regular old cash entry, a regular transaction, not an adjusting entry. And then the subsequent entry will be the adjusting journal entry to reflect that, hey, something has happened, we've used something up, we've earned something, whatever. Now, there are some rules that will help you to develop these adjusting entries and determine whether you're looking at an adjusting entry to begin with. First of all, there has to be at least one revenue or expense account, depending on which type of adjusting journal entry you're talking about. It's either going to have a revenue or an expense. On the other side, there always has to be at least one asset or a liability. Now, what this basically means, if you take a look at this quickly, we have four different things that have to happen and four different types of journal entries. You're going to have a revenue asset journal entry. You're going to have a revenue liability journal entry. You're going to have an expense asset journal entry and an expense liability journal entry. Those are the four types of adjusting entries, and we'll talk about examples. We'll give them names. But what I want to point out here is that cash will never be in the adjusting entry. For these four adjusting entries we're talking about, cash is just flat out not in that. It'll either be in an entry before the adjusting entry or an entry later on after the adjusting entry, but it will never be in the adjusting entry. So now, let's go through some examples of these. Those deferred expenses or the reclassifications, one example is a very big example, is a prepaid expense. And in fact, this is the most common adjusting journal entry that you'll find because it covers so many different examples. Things like prepaid rent, where we paid rent in advance, prepaid advertising. When we purchase supplies, we're not going to use them up till a later period. That's an adjusting entry. Depreciation, in other words, we bought a building, we're going to use it for 20 years, so we're going to expense that over 20 years. So those are all examples of adjusting entries. Now, let's take a look at a prepaid rent. The company prepays 1 year of rent in December of, let's say, 2020, $12,000. Initially, they're going to record just a regular cash transaction in 2019, let's say. So the first year. $12,000, they're going to be debiting prepaid rent, which is an asset, for $12,000 to increase it. They can use this later on. They're crediting cash for $12,000 to decrease it because they've used it. This is not an adjusting entry. It sets the stage for one later on. Now, down the road, every month, in this case December, we used up 1 month of rent, $1,000. So the adjusting entry here to reflect that usage is we'll debit rent expense for $1,000 to increase it. We'll credit prepaid rent, that asset, to use it up. We now no longer have that asset. The next year, we're going to record the remaining 11 months, so $11,000, but it's the same adjusting entry. Now let's take a look at a supplies example. This company buys $5,000 of supplies in December of a year, and at the end of that period, they have a remaining balance of only $3,500. Now we assume they started with zero. They bought some. They only have $3,500 left. Apparently, they used $1,500 of the supplies that month. So we're going to record that entry just to show the purchase of the supplies, debit to supplies to increase that asset, credit cash because we used it. But notice that that is not an adjusting entry. It has cash in it. This sets the stage for a later adjusting entry. The adjusting entry is going to be to show that we've used up $1,500 of those supplies. So we're debiting supplies expense to show that we're using supplies up. We're crediting the supplies asset to show that now they're gone. Crediting supplies asset decreases it. Now let's look at yet another example of these prepaid expenses. This company buys a $500,000 building or an asset of some sort in December. This will be used for 10 years, and they're going to spread it out equally over those 10 years, $50,000 per year. That's known as depreciation. So we're going to record, first of all, the purchase of that asset. We're debiting the fixed asset to increase it for $500,000. We're crediting the cash asset for $500,000 to decrease that. Now this one's a little bit unusual, this particular adjusting entry. With the supplies situation, where it's very similar, only it was short term, we debited the supplies expense, we credited the supplies asset. Here, we're debiting a depreciation expense, so that part's similar for $50,000, but we're not going to credit the asset. Instead, we're crediting accumulated depreciation for that asset. That's known as a Contra Asset account. It offsets the value of that account, as we'll see in just a bit. Fixed asset on the balance sheet, less accumulated depreciation of $50,000, gives us the net book value of that asset, $450,000. Now, the reason for this, by the way, is that when we're talking about these long-term assets, investors and others, they want to know, well, what was originally paid for these and how much has been used up, so they can basically try to predict, well, when do we think this company is going to have to buy a new fixed asset? If this said $500,000 minus $450,000, that would tell the investors that, hey, this company is probably going to have to buy a new expensive asset in the very near future. So that's why they want to keep both. They keep the original asset at its original cost, and then they just keep reflecting how much depreciation is accumulated across all the years. This keeps building up and up and up until eventually this net book value will be zero. They've used up the entire asset. Now that's a very simplified explanation for this. We're going to see it more in a later module altogether. But back to this accumulated depreciation is known as a Contra Asset account. We're going to see a few Contra accounts throughout accounting. Contra, for our purposes, just think of it as opposite or against offset. It's the opposite of the asset account. It's not a liability. Don't think of that. But it offsets that asset account. And because of that, it's going to have the opposite normal balance. So assets have a normal debit balance. A Contra asset will always have the opposite, a credit. That way it allows us allows the two to offset. Now let's move over to the next example, the unearned revenue. Now this is where, certain industries have this quite a bit. Landlords have to deal with it on a lower scale. Insurance companies, airline companies, magazine subscription or magazine companies, hotel reservations, anybody that requires a prepayment of any sort, and then they're going to earn it later on. So in this case, let's say we have the landlord that collects 1 year of rent in advance in December, $12,000, $1,000 a month. We're going to have this initial entry, which is just cash. Debit to cash for $12,000 because we've increased it. We're going to credit a liability account known as unearned revenue. This or deferred revenue, sometimes you'll hear that referred to as. It basically means we have an amount, but we haven't really earned it yet. We owe the customer something. We owe them a service or staying in the building, whatever. So we can't count it as full revenue. We're crediting the liability to increase it. Down the road, every month that passes, we're going to have $1,000 that we've now earned. So we'll debit the liability, unearned revenue, to decrease it, and now we can count it as actual revenue, $1,000. And then the next year, we'll have the other $11,000 that we record as earned revenue. Now we're going to switch gears and we're going to talk about the accruals, the other main branch. Some examples of the most common that virtually every company has if you have employees, unless you pay them every single day, would be salaries expense. But a lot of companies also have interest accrual as well because they've lent money or they've borrowed money and they owe interest. So let's say the employees are paid $500 every week on Friday, $100 per day for a 5-day week. The next Friday payday falls on January 2nd of a particular year. So we're going to record the adjusting entry to reflect the salary expense for Monday through Wednesday of that year, $300. Now notice that with the accruals, the very first entry that happens is the adjusting entry. We're going to debit salaries expense for the $300 to reflect the fact that we've used up the benefit of those employees, and we're increasing the expense with this. We're crediting salaries payable, which is a liability, for $300 to show that we owe them money next payday. Now this one adds a little bit of complexity to it. Now we're on January 2nd. We're going to actually make the payment. So I guess first of all, if we jump to the credit, there's going to be cash. This is not an adjusting entry. We're crediting cash for $500 because that's what we have to pay them. Out of that $500, $300 we already set up as a payable. Now we're paying it off, so we debit the payable liability. But we also have to record the other $200 as an expense. We haven't done that yet. That's an expense this period. So we debit salaries expense this period to record that. The $500 in debits equals the $500 in credits. So the final adjusting entry is also the least common. Accrued revenues. That means we are recording a revenue before we've actually received it or even billed for it. Interest is a common example here. We've earned revenue, interest revenue, but we just haven't collected it. Or we could have some services that we've earned the revenue, but we haven't billed for it. We haven't collected it, obviously. So let's say this company, let's say it's a hospital. They've earned $100,000 for services for a variety of customers provided in December of this year, but they haven't billed for it yet. They haven't collected it yet. Company policy is to bill for all services on the 15th of the following month. And I will say I work in Medicare audit. We deal with a lot of hospitals, and a lot of them have policies similar to this, where they don't bill every single day of the month. They bill in batch on a certain day of the next month. It's just easier for them. The point is, the 15th is next year, next month and next year. We need to record this in the proper year when we earn it. Now, if they had billed for it, by the way, the entry would be this same entry as the adjusting entry. We would debit accounts receivable to reflect the asset that we are entitled to for $100,000. We'd credit revenue to show that we've earned $100,000 of revenue. But the point here is we haven't even billed for it. If we billed for it, there's no need for an adjusting entry. But in this case, we haven't billed for it yet. So we're going to force the journal entry to include both the accounts receivable asset as well as the revenue credit to show that we've earned the money and we're entitled to it. And then when we get around to billing it, there's no additional entry needed. It's already recorded properly. Now let's get to the actual January where we collect this. So we debit cash for $100,000 because we've collected it. We're increasing cash. And we are crediting accounts receivable to reflect the fact that we're reducing that now because we're no longer entitled to it. We've collected it. Now, the whole purpose of these adjusting entries is to get data that we can use for financial statements. We're going to start the period next year or next quarter, whatever it happens to be, with zero balances for many of the accounts, all of the income statement accounts and dividends. So as far as some terms here, what accounts do we close? That we're going on to the next step of the accounting cycle, talking about the closing entries. We have what are known as permanent accounts or real accounts. These are our balance sheet accounts versus the temporary or nominal accounts, and these are essentially our income statement accounts and dividends. So again, the permanent accounts include assets, liabilities, the capital or common stock, the retained earnings. These keep their balance until the company completely closes shop altogether. The temporary accounts are in revenues, expenses, and dividends. Those accounts are going to be closed out to retain earnings eventually. Now, as far as the closing process, there are actually a couple of different options you can use. Option one is that you use, first of all, this very temporary account called the income summary account. And in that case, you close out revenues and expenses to this income summary account just to give you a picture of what the net income was. Then you turn around and close that income summary account out to retain earnings. In other words, this one account is opened up and immediately closed. It only exists for a split second there in the closing process. It's almost a check figure, if you will. You close that out to retain earnings. Then you go ahead and close dividends out to retain earnings as well. Option two is that you just do everything straight to retain earnings. Close revenues and expenses to retain earnings, close dividends to retain earnings, and you're good to go. So when we say closing, we're talking about zeroing out a balance. So in this case, revenues, they should have a credit balance. That's the starting balance before we do this process. So the closing entry has to include a debit to revenues. Notice we have a debit to revenues to close it. The credit to this journal entry has to be the same amount, and it has to be a credit so that we can have a proper journal entry. That's going to credit retained earnings. We're essentially moving this credit balance of revenues over to a credit balance of retained earnings, but we have to do it through a journal entry. Expenses are going to have the exact opposite. We start with a debit balance of $1,000. We have to credit expenses for $1,000 to zero it out. So credit expenses for $1,000. We know we're going to debit retained earnings for $1,000. Now, all this other stuff is what has happened before in retained earnings. Now we're debiting retained earnings for the $1,000 expense. So again, we're moving the debit balance from expenses over to become a debit balance for retained earnings. Now, the last one is dividends. It's going to follow the same basic approach as expenses. It starts with a debit balance, so we have to credit dividends for $200 to close it, and we're going to credit or debit retained earnings for the same amount. So now we have another balance in retained earnings. Now, the whole retained earnings process, if we take a look at this T account, we started with 13. We added $1,500 on the same credit side. Remember, credits increase retained earnings. It's an equity account. We debited for 1,000, which reduces retained earnings. We debited for 200, which reduces retained earnings. So in the end, our final balance is $1,600. That takes us to the end of this Module 2 discussion, where we've made our way through the accounting process. It's going to be important to understand this as we move forward. Hopefully this has helped to clarify, but I thank you for your time, and I'll look forward to talking to you in Module 3.